Managing other people's money is the most powerful wealth building tool that exists, but it's also the fastest way to lose everything if you don't understand what you're actually stepping into. Everyone teaches you how to find deals, how to raise capital, how to structure an offer, but the moment that someone wires you their life savings, there's no playbook for what that actually feels like. I built $1 billion portfolio using other people's money, and before that, I spent years inside BlackRock managing over $10 trillion. And I've sat across the table from everyday investors, including also billionaires, royalty, and even sovereign wealth funds. And across every level, I kept seeing the same thing. The operators who scaled and the people who ended up collapsing weren't separated by the quality of their deals. Rather, they were separated by things that nobody teaches. So let's talk about what actually determines whether you build something that lasts or something that quietly falls apart. Now, the first shift happens the moment that capital hits your account, because up until that point, everything feels theoretical. You're underwriting deals, you're projecting returns, you're thinking in terms of spreadsheets, and then the wire comes in. And now it's real, because it's no longer your money. When it's your own capital, a bad quarter is frustrating, but you adjust and you move forward. But when it's someone else's capital that you're taking care of, that same bad quarter carries much more weight, because that money represents someone's retirement, their savings, their child's education, all their future plans. And suddenly, every decision you make feels heavier, because most people prepare for the financial side of this, but very few prepare for the psychological side. And that's where things start to break. At BlackRock, I watched extremely capable people struggle under that pressure. Not because they didn't understand the markets, but because they had to build the ability to separate their emotions from their fiduciary responsibility. And because of that, instead of proactively operating, they were instead being reactive. And the truth is that the market doesn't always punish bad intentions, but it almost always does punish unstable decision making. And the operators who make it past their first deal or fund aren't the ones who are chasing the perfect deals. They're the ones who can stay clear, steady, and investor focused, especially when things don't go as planned. There's no more famous investor out there than Warren Buffett, who's famous for preaching and being able to implement better than anyone the practice of staying level-headed in times of both extreme fear or mania, all in an effort to serve as a good steward of investor capital. And he's practiced this consistently since the days of his very first investor. Because that moment right there, when you first feel that weight of someone else's hard-earned money under your control, that's where your real career starts as a money manager. Because from that point forward, every decision compounds, not only financially, but also reputationally. And if you zoom out for a second, there's also something else happening that most people miss. And the way institutions handle this is completely different from how most operators out there are taught. You see, I spent years inside the largest investment firm in the world, and inside that environment, investor trust wasn't treated casually. It was engineered, and the experience was completely choreographed. There were systems around it, frameworks, protocols, and everything pointed toward one outcome, which is making investors feel secure enough to stay with you through any market condition. And the first thing they do is they remove surprises. Investors hear bad news immediately, not at the end of the quarter and not after things are already cleaned up. As soon as it's known, they are notified. That single practice changes the entire relationship dynamic, because when investors hear it from you first, it builds confidence in how you operate. Because if they end up hearing it later from somewhere else, then the damage is already done. Most operators, they delay tough conversations. They wait and avoid being uncomfortable, and they hope that the situation improves. But what actually happens is that trust is eroding quietly before the numbers even have a chance to even recover. And the second thing that successful operators do is they separate information from interpretation. In reality, investor updates always have two layers: what happened and what it means. The numbers alone don't explain the full story or calm investors, which is why context is actually needed. Because when investors understand why something happened and what actions are being taken, their response changes completely. But without that context, people fill in those gaps themselves, and the stories that they come up with to fill in those gaps rarely work in your favor. Now, the third thing that good operators do is they bring investors into the process, not just give them updates, but also give them visibility and transparency, such as how decisions are made, how portfolios are constructed, and what the thinking looks like behind the scenes. And that level of transparency creates a deeper kind of relationship. It turns passive investors into long-term partners. And the beauty of these three actions for being a good operator is that none of these require more capital. It just requires you to be intentional. Now, quick pause here. If this video is clicking for you, there's a reason for that, because most people out there, they never consider this side of the business until they're already in the middle of it and have little choice but to be reactive. But if you want to plan for and apply this to your situation, then book a free strategy call below, and I'll walk you through exactly where you are right now and how to structure this the right way without having to go through a bunch of trial and error. But before that, there's one more piece you need to understand, because this is where most careers quietly end. And there's a line in this business that almost nobody sees clearly until they've already crossed it. And it doesn't come from a bad deal. It comes from a broken expectation. You see, Every time you accept capital, there's an agreement that exists beyond what's written on paper because you're stepping into responsibility for how that money is handled, including the level of care, the level of urgency, and level of communication you provide. And investors feel that very, very quickly. And the moment that standard slips, even slightly, then the relationship starts to change. And it's not always visible, but underneath, there is a subtle shift that happens. And it's when communication becomes reactive. When updates start happening after questions are asked instead of before. When clarity turns rather into explanation or worse, justification. And that's the moment that trust starts to fade. And most operators, they don't notice the difference from investors right away. What they notice at some point in the future is fewer referrals, less enthusiasm, and investors hesitating to invest in their next opportunity. And by then, the pipeline is already slowing down. The operators who scale from their first million to hundreds of millions treat investor communication like a core product of their business, because it really is. It's something that's built, refined, and delivered consistently, independent of how deals are operating. Because in this business, trust compounds much faster than returns. And once that trust is gone, it's gone forever. And at the end of the day, managing other people's money isn't just about raising capital. It's about managing trust at a level that most people underestimate. The psychological weight is real, and people prepare for it before they feel it, make big decisions when it matters most. Now, these institutional frameworks are available to anyone, and you don't need to be managing billions to operate like that. You just need to implement them early and get started, because you're always either moving towards stronger trust or slowly moving away from it. And there really is no neutral ground in between. Your first dollar of outside capital starts building you and your reputation that compounds over time. And every decision you make builds on it, and every interaction you have reinforces it. So the question becomes, what are you going to start building? Now, everything I just shared with you took years of experience to learn and master. From inside BlackRock, inside JP Morgan, and from building a billion-dollar firm from the ground up. The fact is that most people learn these lessons after something goes wrong, like after an investor pulls out, or after trust takes a hit. But you can approach this differently and avoid those pitfalls. Inside of Money Raising School, I break down the full system behind having a limitless capital raising machine, the frameworks, the communication structures, the psychology, the legal foundation, and more. Everything you need to manage outside capital the right way before you ever take your first dollar. Book a free strategy call below, and I'll show you exactly where your current approach stands and what needs to change before you step in front of serious investors. And if you're ready to go deeper, then watch this next video, which builds directly on what you just learned and shows you how to start applying it immediately.